Hello, welcome to Any Answers Answered for February 2023. Delighted to say we're on the new set of Tax TV. Do remember to join us every month for that. But as far as Any Answers is concerned, the same format remains with two questions from the pages of Any Answers considered by Tim and me. And we start with a question from CW Services 6064. Who'd have thought there'd be 6,063 other CW services already on the website. And the question, Tim, is as follows. It's to do with A and B shares. And the question, quite simply, as this company is set up with A and B shares to father and son, they both have voting rights, dividend rights are equal, right to participate in capital, all that sort of thing. However, dividends have historically been paid equally on the A and B shares, but the father is now winding down his involvement. So we'd like to reduce his dividend or sometimes not take one at all. I believe this is fine. Tim, is it fine?
Well, yes. But of course, the questioner didn't finish there. The questioner said, I believe that this is fine unless it comes to a point where distributable reserves would not have been sufficient to cover dividends if they were paid equally on all shares. And the first point that we should make is that the issue about the distributable reserves being sufficient to pay the same dividend on all shares is one that we're familiar with when advising on dividend waivers. And the particular case that springs to mind involved a Mr. and Mrs. Buck. And when setting up his company, Mr. Buck was advised by his accountant to issue, I think it was 9,999 shares to himself and just one share to his wife. And at a later date, the company declared a dividend, all of which was to go on the one share to the wife because the husband waived his entitlement to the dividend. And my recollection, I haven't looked it up recently, but my recollection is that that dividend was of the order of £30,000. Now, in order to pay a dividend of £30,000 on all 10,000 shares, the company would have needed distributable reserves of 10 million. And in fact, it had distributable reserves of, I think, about 40,000. And so if it were to pay the distributable reserves of 40,000 for all of the shares, then it would only have paid £4 per share. The wife would only have got £4, not 30 grand. And the revenue succeeded in arguing that that constituted a settlement of income by the husband on the wife that was not bounteous, and that the income should be taxed on the husband rather than the wife. So we've got to be very careful with this sort of thing where we're looking at dividend waivers. I'm not, however, aware of the same issue where we're looking at Alphabet shares. And it seems to me at first instance that it would be possible to do what the father and son are suggesting in this case, which is just pay the dividend as long as the distributable reserves will support it on the son's shares and not on the father's. But there could be other issues here. And I note in the question that the information is that the father has decided to reduce his involvement in the company. It says, if I go back to it, the father's now winding down his involvement, so would like to reduce his dividend or sometimes not take one at all. There's a slight risk there that the revenue can argue that the dividend is disguised remuneration. But it's very unlikely that would happen. I'd just be a little bit cautious about expressing that particular side of the arrangements too clearly.
And one other thing I would point out in their favour is that there is this history of the 50-50 shares. The point is that we have not just this, we've set up a company, we've immediately started to pay strange dividends to different people. We're in a position where we are clearly historically paying 50-50. It's just this later decision that we're going to change it. Always easier to say to the revenue, we didn't set the company up to do this. It's just how the company is developed. So that could be a potentially very important thing to consider. Our second question comes from Snickers in a Twix. And Snickers in a Twix asked the question, 4-year time limit when dealing with tax returns, but quite a curious one. Our client works for the NHS with a final salary pension scheme. This year, the pensions department wrote to her and told her that the pension input amounts have exceeded £40,000. She may have excess contributions. This is the first time they've written to her. However, the question then goes on to point out that they have the details for the last few years for the first time. And if you add together the two schemes, very common in the NHS to have these two schemes operating side by side, through the carry basket, etc., she has over-contributed past the £40,000, not just 21-22, but all the way back to 17-18. The question, therefore, Tim, basically is, although it's worded in a very odd way, the fundamental question is, what should they do about this?
Well, the answer is they need first to do the calculations and then to disclose to HMRC if there have been any underpayments of tax, which there will have been. At the time of recording this, there are over 30 comments added to this Any Answers query, and most of them reflect the extent to which this is a problem, particularly for those employees who get the benefit of NHS pension schemes. And the comments vary in terms of what the actual approach should be and whether this has been a careless error or it may just be an innocent error. And of course, the difference between carelessness and just an innocent error will engage both the question of penalties, but also the question of other cases than this, the question of whether the revenue could make discovery assessments. My own view is that if you know that you are a member of an employer pension scheme, then you should be aware of the tax consequences if your pension input amounts, the growth in your benefits, exceed your annual allowance. And it would be careless not to be aware of the potential tax implications and report them if appropriate. So although the original poser of the question says she has not been careless nor fraudulent, certainly she's not been fraudulent, but I would have thought there was a possibility of a carelessness argument, as do one or two of the commenters below. It is horribly complicated. The pension scheme should be notifying the pension input amounts each year, and that notification should prompt the taxpayer, the scheme member, to consider whether it gives rise to any tax liability. Now is not the time to go into the detailed calculations, but it's quite interesting to read the comments that go below this one and to see what the general view is as to whether this is something that is just an innocent mistake. For example, Old Park Accountant says, if you work in the NHS, then the pension tax problems are very much something you are aware of. It's been an ongoing conversation with staff from nurses up to consultants for years. There is little chance of this being an innocent mistake. But then the next commenter says, I would disagree somewhat. I could easily agree that this is an innocent mistake. So it's, unless the revenue decide to take action, who knows? But my own view is that all of the pension input amounts should be reported. Well, all of the annual allowance excess charges should be reported. Going back, the key question for the original poser of the question is, how far back do we go? Should it just be to 21-22, but should it be all the way back to 2017-18? And I would have thought that you should really come clean on the whole lot, but yeah, certainly 19-20. Where are we now? 4 years on from 17-18. Well, it's 6 years if the revenue want to make a discovery assessment.
So the answer really is to make sure that anybody working in the NHS has considered this, because while we can say it's unusual, it is very common in that particular industry with these two pension schemes working side by side. It is a problem that a lot of people face. So we need to make sure that we're happy with this. I guess the answer to the question is good luck and hope for the best, but do the maths as early as you can. That's all for this month's Any Answers Answered. Do join us again next time when we will perhaps consider your question from the pages of Any Answers Answered on Accounting Web. Thanks for watching. We'll see you next time.